set the context for today's discussion, we're going to cover key themes and trends impacting investments in the digital infra space. But we're kind of working off the premise that a lot of folks here have probably been at all the great conferences recently and listening to a lot of the panels touching on trends and themes. So from those trends and themes, really our primary focus is to lead the conversation towards finding out key tools, key practical considerations for investors to keep in mind from our advisor point of view of helpful things to get successful deals done in the space. To do that, we've set up a pretty diverse panel here of advisors. We have everything from financial due diligence, tax, legal, regulatory, commercial DD, lead financial advisory, missing a couple key roles that you would have as an advisor on your team, but effectively we've kind of come up with a diverse group of what an integrated sector-focused M&A deal team looks like. We have 90 minutes. We're going to budget some time for Q&A at the end. And as Heather said, there's a mic in the room. Definitely encourage interactive conversation if folks have questions that pop in mind or if you want us to go deeper on certain topics. We can budget that in too, so just wave us down and we'll find the right time to pause. So to get into it, we'll do intros. I can go first quickly again. Kevin Burke, Managing Director of Burke's Financial Advisory Practice. We're a specialized M&A team focused on buy-side and sell-side financial due diligence, synonymous with quality of earnings, QOD. We do M&A integration, carve-out, and separation work, and we have dedicated infrastructure financial modeling. And our team is fully sector dedicated to infra, energy, and renewables. Myself, I get to cover digital infra for us. It's a passion of mine, and because of that, I get to work with a lot of infra PE and sponsors in the space and management teams in the space, and primarily my role is financial due diligence, so that's what we're speaking to today. Tania, you want to start down there? We can work our way back.
Sure. My name is Tania Wang. I'm a tax partner at Berwick, complementing Kevin and his team on the financial side, really focused on tax diligence, structuring, modeling around deals. I've been in M&A tax for over 20 years now, really advising in this space specifically around returns and cash X impact to deals. And so really heavily focused in the digital infrastructure space, working a lot on data center, fiber, tower deals.
I'm Richard Lukaj. I'm with Bank Street, one of the leading boutiques that focuses on digital infrastructure and services. We, I guess, have a group of professionals that have been around for a very long time and have seen a lot of cycles and worked on a few things. And I've been told that I've got to find a way to keep the humor value very high here because it's early on a Monday morning. And I'm honored to be here. Thank you for setting this up, and look forward to a lively discussion today. Our practice, for those of you who don't know us, is really broad across the digital infrastructure space. It is also a global practice, so we are often seen in cross-border and cross-discipline type transactions. We've been blessed to be able to evangelize themes and developments across our spaces for a very long time, and therefore bring the perspective of history as well as the breadth of recent experiences to the table. Looking forward to this discussion and hopefully a lively Q&A with the group here.
Ed Vilandrie, Managing Partner at TBG. We're a newer boutique strategy firm focused on digital infrastructure and related services. And we've been around now for just a little bit over a year. We've gotten going here. We've had about 24 clients in the first year, about 70% private equity infra fund, 30% operators directly, some PE-backed, some public companies. And what we do within the space is entirely, from this perspective, commercial due diligence, and a lot of buy side, some sell side. So anything around market trends and performance of the business from a qualitative and quantitative standpoint, objective third party, and obviously partner with a number of my colleagues around the table on due diligences for funds and for strategics as well. I spent about 25 of my 30 years as a consultant, and 5 years also as an operating executive at the Carlyle Group, where I currently also have a role.
Hi, Mike Muller. I'm a partner here at Morgan Lewis in the Boston office in the Energy and Infrastructure Group. My specialty is kind of across asset classes in the energy and infra space, specifically in digital infrastructure. I've worked recently on a couple of financings for home to fiber companies, acquisition of fiber assets, and currently doing a lot of work in the data center sector, both on the development side as well as the powering data centers, both from the data center side of acquiring power, both long-term as well as backup power generation, and then from the power side of offtake to data centers. And in my practice, as I mentioned, kind of across asset classes, but also unique in that I also am across sectors within the legal spectrum. I do development, equity, investment in M&A, as well as financing, just in the way my practice has evolved. So all things transactional across different infrastructure sectors, and I'm looking forward to this conversation today.
Thanks, Mike. I'm Andy Lipman. I'm also a partner here at Morgan Lewis, and I head up our 30-person telecom media tech group. So if no one said it before, welcome to Morgan Lewis. And no one's ever starved at Morgan Lewis, so please feel free to take your full share of second or third breakfast. I not only have headed up our telecom practice, but also, while being a lawyer in an outside law firm, I headed up the legal and regulatory work both at MFS WorldCom, and for 3 years I was senior legal and regulatory counsel at MCI. So I've been on both sides of the table, been on a number of boards. While at MFS, I headed up the legal work for the first 2 data centers in the country, May East in Ashburn, May West in San Jose, although we were too dumb at the time to realize they were data centers. But that also is a big part of our practice. So our group covers the entire spectrum of digital infrastructure, towers, small cells, subsea, local fiber, fiber to the home, mid-mile fiber. And I also write, as many of you know, a free weekly report every Friday, 5 to 10 pages on broadband. And if you're interested, let me know. So welcome, and we're all looking forward to this dialogue.
Amazing. Let's get into it. Rich, maybe starting with you to kick it off for us. You work with tons of investors, management teams in the space. If we were a fly on the wall, some of the meetings you're having over the past few months, some of the deals you're working through, it'd be great if you can share top of mind conversations, considerations you feel coming out of investors and management teams.
Well, thank you for that. I'm trying to figure out how to be more OG than the OG. But I think I too want to thank everybody for joining us this morning, and Morgan Lewis and Berwick and others for bringing this all together. I think the conversation today actually is very timely, and your question is also very aligned with where I think the state of play is in the ecosystem at the moment. There are times in the backdrop, particularly across the TMT space, where the themes are broad stroked, and so it's really a land grab kind of an opportunity, like the old days of commercial fiber, going back to MFS and some of those stages of the industry, where grabbing a market opportunity, encircling it, building a competitive moat such that you had real franchise value and something really strategically valued through time. the same kinds of things have happened in the satellite space at different times. Subsea certainly was no exception to that. I think the recent phenomenons, recent meaning the last 10 years of folks going after the consumer broadband market have had similar broad stroke themes where I would say great wealth was created by virtue of seizing market opportunity. The data center sphere has had many life cycles. We started doing data center transactions in the early 90s when, as Andy referenced, some of them were really interconnection facilities that later became redefined as data center facilities. Some were the early vintages of shared infrastructure for small and medium-sized businesses to get professionalized hands on data center infrastructure instead of relying on somebody to go into some closet and hopefully have some idea what they were doing with the infrastructure. The evolution has moved on to a much larger scale proliferation, and I think the development cycle has been where the recent headlines have been focused mainly on I'll call it build-to-suit types of solutions for some of the largest consumers of data center capacity on Earth. As you might imagine, the dynamics around each of those sectors is considerably different. The risk reward that you're playing for, the return proposition that you have any opportunity for. The competitive set is quite different across every one of those spheres. And maybe translating all of that, because we could go on for a while on the varieties of things that are happening across the ecosystem. But as a digital investor or operator company board, this is a backdrop where the broad strokes are dangerous because you could really miscalculate a perspective on a specific investment opportunity or a specific company in a sector if you're just using a macro perspective on it. There are, within every one of the spaces I just described, folks that are ideally situated with an addressable market opportunity that will be profoundly good. There are folks that are in the same sector, in some cases even in relatively similar geographies, folks that are at risk. And I think in the context of putting together what this group humbly called the Masterclass, it's important to note that in this time, all of those perspectives become really, really important. And the granular perspective around industry opportunities is profound. The dollars that are in play are probably the biggest they have been in terms of transaction sizes in a long time, in some cases ever, in some of these spaces. And as a result, I think having a perspective that is deeply ingrained in the foundational elements of that space and sector, and also distinguish whether or not there's a unique defensible market opportunity. I think these are things that need to be assessed carefully. And I would also say that the capital markets have been extremely efficient, and so I think there is a need to perhaps have all of these elements in place because the cost of capital is a distinguishing feature around each of these opportunities, and it can be the make or break around the success of a business if people are slightly off. Maybe to provide an example, these days if you're underwriting a transaction to a single-digit return because of your quality of counterparties involved in a transaction, if a few things go wrong, the business could be undone from a returns perspective before you even get started. So never has there been more need to have more perspectives and take a more careful view of a situation than we find ourselves in today. So with that, I'll cede the floor back and just say that maybe in closing, the thing that makes a successful transaction team these days is having a variety of concentric circles of knowledge around the circumstance, and that involves everything from market assessment, network and technology, and infrastructure assessment, tax and other considerations that can make or break, particularly cross-border transactions. And then obviously the legal and regulatory element in volatile times becomes ever more important. And obviously from an investment banking perspective, whether it's a strategic joint venture, the complexities of understanding how all of these things coexist, or in transactions where there's separations involved, understanding how they need to exist independent of each other, understanding and appreciating how to orchestrate all of those resources to ensure success on the objective is a large part of what we bring to the table in partnership with principals. So look forward to our discussion further.
Great. Appreciate that, Rich. Anyone want to add to that?
Yeah, I mean, I think that, kind of building off of what Rich was saying around just the capital that's coming in, the new investors that are coming in, we're seeing a lot of non-US investment come into the digital infrastructure space, just given the need for additional capital. And a lot of that capital is also coming with some meaningful requests from a tax perspective around structuring that are really driving operations and how things are working within all sectors. Data centers in particular, really seeing a lot more push for REIT structures in order to kind of create that tax efficiency. And also kind of with the new domestic content, or sorry, the domestic DC REITs, we have really more focus there around potentially getting foreign investors also outside of FERPTA. And so as we're working a lot with infrastructure funds that have non-US investors that are really focused on after-tax returns, really a push towards further structuring around REIT structures and also managing FERPTA.
If I could just piggyback on that. So while I think this is a good environment, for infrastructure investment, let me give you a Washington, D.C. perspective. So, what we've seen historically in the last few administrations is really regulatory whiplash. Going from a Democratic administration, Republican administration. No matter what you think about this administration is all in on digital infrastructure in a lot of different ways. And to some extent, they're looking at it as an arms race in DC. And that really emanates from the White House. And I can tell you there's enough daylight between the White House, the FCC, the Antitrust Division, and all the other agencies, Treasury, Commerce, NTIA, who are involved in telecom. First of all, we have a very favorable tax climate. And that could change in 3 years. We have bonus depreciation, we have the R&D write-off, we have a very favorable antitrust environment. I mean, not just for mega deals, but for smaller deals. We're seeing fewer second requests, we're seeing deals moving quickly. We're not seeing the obstacles, the headwinds that we've seen in prior administrations. Just recently, the White House, the Department of Energy directed FERC, to make it a lot easier to get power behind the meter, grid connectivity. Again, this is an all-of-government effort. Another effort that we've seen most recently is licensing and permitting reform. I was pretty involved in the '96 Telecom Act, and the one provision that didn't pass over the support of the sponsors was Section 253, the licensing and permitting reform, largely given the fact that the mayors pushed back. They didn't want to give up their dominion over permitting and licensing and franchising fees. That is, this is now 30 years later, that is now finally changing. This administration, the White House, the FCC, wants to make it a lot easier for permitting and licensing, not only for data centers, but for fiber and cable as well. One other thought, and you correctly mentioned a lot of foreign investment, in this sector, which is something that this administration is encouraging, unless you're a foreign adversary, China, Russia, Denmark, maybe Canada. Putting that aside, what we're finally seeing, and this is something I've been spending a lot of time with, along with my partner David Levinsky, who used to head up the CFIUS Team Telecom branch at the Department of Justice, is what I call the equivalent of TSA pre-check. Okay, so basically, if you come from a Five Eyes country, UK, Canada, Australia, New Zealand, or other European ally, there should be a fast track for CFIUS. And Treasury is working on that, or at least they were before the government shut down. We have 2 or 3 clients involved in that experiment. If you're an infrastructure fund, a foreign infrastructure fund, and you want to be part of this test group, you should either talk to me, talk to Treasury, get involved. And it's not so much for CFIUS, but it's for Team Telecom. CFIUS we can usually get through in 4 or 5 months. Team Telecom can be a 9 to 12 month process. And it's a competitive disadvantage if you're not part of the process. So how does Team Telecom work? It's implicated if you have a 10% or greater foreign investor. So I can tell you there's a lot of firms located between 47th and 59th Street, that think there's American as cherry pie that still gets ensnarled in Team Telecom, because they have a UK or Canadian investor. If you can get on a fast track on that, that would really be a great tailwind for broadband infrastructure. So, just another thing to consider.
Just piggyback off of one thing that Andy mentioned, I was going to mention CFIUS as well, but I think he hit that. With respect to Burke, on powering data center and assets specifically, we not only have seen over the past 12 to 18 months a pretty solid change in the way in which the regulations have handled behind the meter located power generation, but also EPA regulations that were really restricting any new build generation on the conventional power side. We're going to impair the ability of quickly powering or dealing with the demand surge for data centers specifically. And I think both of those changes that we've seen from the administration have at least altered the conversation about how we're going to power the demand that we've seen increase as the scale has built up over the past recent years. And so I think, as Andy was saying, I think from an administration standpoint, like it or hate it, there are certainly, we went from having headwinds to the way in which we were dealing with certain obstacles to the data center build out to perhaps some tailwinds, which is positive kind of across the spectrum when you're looking at the way in which we're proceeding on these developments.
Just shifting to commercial for a second, all of the data center demand that's being built in the AI training cloud data centers, there's definitely a natural evolution of it out to, those workloads will need to go somewhere, right? So I think one of the trends I'm tracking closely is what are assets that maybe have been somewhat out of favor that might have a resurgence in growth and value, more edge, maybe more newer, more rural or regional fiber networks, some which might be greenfield builds off of existing platforms or other capabilities that might be built, throughout the ecosystem. The other trend is, to Andy's point about the government in the U.S. really being very pro-digital infra. What is the reaction of other places in the world, and will there be an AI training boom elsewhere? What other geographies will that be, and which players are really well situated to take advantage of that?
I was just going to add one more thing that sort of struck me as I was listening to Andy and Mike talking about the legal maneuverings and the opportunities perhaps for fast tracking. I think on the other side of that is also the opportunity to avoid big pitfalls that can come into play. I think in my 35 some odd years, I don't think we've ever been at a time where we're bringing legal into the equation on a transaction earlier as part of the planning maneuvers expediting opportunities that exist in a transaction. There's also increasingly, I'll call it, mercurial dynamics around the international marketplace, and that translates itself sometimes to the investors' ownership themselves. In other cases, it translates to the actual doability of collaborations between would-be partners in a transaction that is best assessed early. And in some cases, that lends itself well to a preview, sometimes on an anonymous basis, sometimes on a fully vetted basis, to ascertain if everybody's wasting their time. And I would say that going back to sort of the dynamics of the day here, as the winds are shifting from time to time, while I did find it humorous to hear the inclusion of adversaries, I think it is also a sign of the times where it is worthwhile to ascertain what you might even have thought was a foregone conclusion in the current realities. And I think the legal and/or regulatory aspects of transactions, therefore, have migrated to higher import, and I think that's here to stay for a while.
Yeah, I'm surprised. I mean, I think on our end, like at least on the tax side, we definitely get more conversations earlier on, but then even also kind of post-mortem on deals that have died or haven't gone the way that they wanted to, really thinking about how to structure, fund structure specifically to be as most efficient as possible in order to be really competitive in the bids. And I think that's becoming, an increasing factor for a lot of either non-U.S. managed funds or U.S. funds that have a significant amount of foreign investment. And so it's interesting to kind of manage that dynamic, and then also really understanding return profiles and whether or not a fund is looking at returns on a pre or post-tax basis. FERTA and REITs and all of these kind of factor into everything really heavily, and especially when you're looking at bonus depreciation and being able to do that conflict with REIT structures is can be pretty meaningful. And so working through the numbers to really kind of model out and figure out how to best structure funds based on investor base has been pretty meaningful.
So just to add to that, in terms of structuring, I mean, if we're seeing deals fail, in large part, it's because of timing. Okay, we were talking earlier about Verizon Frontier. Okay, this deal is going out 15, 16 months. Okay, I mean, Verizon has the financial wherewithal to persevere. A lot of buyers don't. But, there are ways you can structure it. I mean, one thing, apropos what we were just talking about is how do you avoid, the long poles in the tent? How do you avoid California PUC approval? I mean, a number of deals we've had, we've structured the deal to have a two-step closing, have everything closed and then California, or to give up the California license to restructure it in some different way. Another thing we've done to avoid team telecom review, again, that could be 12 months, often a long pole in the tent. Convert your common carrier licenses to private carrier. Give up your international 214. Have somebody else operate it for a while. So there are ways to structure it to avoid FCC regulation, state PUC regulation, obviously ways to structure it to avoid antitrust review. I mean, not just in the U.S., but if it's in a global deal, often the long pole in the tent is going to be the UK or the EU. So, I think as Rich was saying, doing this up front, saves a lot of angst down the road, particularly when everybody, including financial partners, are anxious to get the deal closing, and, interest rates are fluctuating back and forth like a shuttlecock. So, again, since it's a masterclass, there are steps you can do to ameliorate all this.
I was going to add one more thing on this tax and structuring side. I think the other element in the wind at the moment is, with all of the maneuverings between nations of recent times, it is discernible early on in some cases where the pitfalls could be. And I think also the ability to be watching. There are a lot of really what seem to be very attractive investment opportunities across some of the same digital infrastructure themes that we have here in the U.S. in some of the emerging markets. And in some cases, folks have invested a lot of time only to discover that they could never repatriate their investment back to the U.S. And that's something would have been good to know early on. The tax effects of some of those types of transactions can make or break. I used the repatriation as an extreme example, but the tax effects on these transactions as well, and the treatments of them relative to the source of the investor. Oftentimes, we're very focused on the investor from abroad that's going to seek to invest in the U.S. As U.S. investors abroad, there are similar kind of reciprocities that make this an interesting time, with its own challenges and opportunities that present themselves in the context of the macro backdrop. So more than ever, probably bringing on board the full disciplines early on in order to devise and also monitor the key variables in play that a transaction engenders. And again, I think orchestrating all of this is not an easy thing, because in many cases, if you look at some of our working group lists of late, there's armies of people across every discipline, and sometimes we're finding ourselves being orchestra leaders and making sure that no one loses sight of any of those concentric circles in the transaction that is the key to making it successful, and the key to also monitoring the pathway so you don't keep going if a key fail-safe has been triggered.
Amazing. That's great conversation across all the categories that applies to the range of categories within digital infra. Maybe we kind of shift the conversation a little bit and touch on the different categories, start with fiber, broadband, getting into data centers, and then power and wireless. See how we do on time, because we can leave this conversation flexible because it's going in good directions. But taking the facilitator hat off for a second, starting with fiber, specifically fiber to the home, fiber to the prem. I'd say, as a generalization, a lot of the investments going into digital infrastructure have been growth-oriented. And that's certainly the case for fiber to the home, fiber to the prem over the past 5-10 years and now. There's exceptions, but that's generally the case. And from an FDD point of view, because of that, it becomes critical to tailor the diligence to understanding the economic drivers, key risks of a capital-intensive, high-growth business. And for a lot of infrastructure investors in this space, that's a bit of a newer concept relative to other assets within the infrastructure portfolio. And so when we tailor our diligence to that, to understand really value and the risks, it really becomes looking very closely at the most recent run rate financial performance of the business and assessing the quality, nature of the backlog, and because of all the high growth that we've kind of discussed going into it and the length these deals can go, also getting comfortable with foreseeable growth into the future in terms of subscriber trends, CapEx spend, potential government grant funding coming in between that time of diligence and closing. And because there can be a lot of growth going on during that time, a lot of major dollar value and cash flow kind of shifting, understanding that earlier on and kind of alignment between bidder and seller and where the cutoff can be at closing becomes key. And another angle we take to it is having a dual lens of dissecting a fiber to the prem business between the mature, stabilized aspects of the business. And that's really where you can have insightful historical views into things like historical CapEx, build performance relative to budget, relative to initial plan timing, and insightful historical subscriber trends, and really effectively getting down to a stabilized, predictable, recurring EBITDA and operating cash flow. And there's a lot of noise when you look at these businesses because the other side of it is the high growth aspect. And there, you need to kind of split it up and look at separately of the in-flight premature markets, what type of value is attributable to achieving terminal pen on those markets where the CapEx hasn't been spent, a lot of work has been done. What is the quality of the backlog and the near-term trajectory that you can get comfortable with in your valuation? And that brings in, obviously, assessing the current CapEx build plan and what that's going to look like between the time of diligence right now through to closing, and who's going to be responsible for what, buyer, seller, and also that brings in grant funding and different aspects which can have large dollar value swings just over a small period of time, and to effectively have deals not dragging out and dealing with these concepts later on, like jumping on these earlier and knowing exactly what is going to move the needle closer to signing and differentiate bidders becomes critical. And that's a launch point, I think, because I think somebody here knows quite a lot about grant funding and what's happening in Washington. So, Andy, you want to give us a rundown of the latest?
Sure. So
program?
There's nothing like the $65 billion in the infrastructure bill to get the industry's attention. It's like the telecom equivalent of an open bar. And so of that 65 billion, 43 billion is the BEAD program, a last mile program that we talked about. Whiplash, we've seen that whiplash, the very different perspective of the Biden administration, the Trump administration. We're actually in the ninth inning of BEAD. Virtually every state, maybe with the possible exception of Texas and California, are going to have their final plans approved by the NTIA December 3, and Texas, California, probably, by the end of the calendar year. Interestingly, the Trump administration was very anxious to have this program technology neutral. The Biden administration was all in on fiber. Why do they love fiber? It wasn't that the Biden administration loved fiber. It's that the unions, the CWA, the IBEW love fiber because it's more jobs. But even so, it looks like 65 or 70% of the homes passed are going to be fiber, which is about 82% of the dollars. There is, however, going to be about a third of that money returned because there are many fewer underserved homes now than there were before. One thing we've been pushing for, maybe some of your companies are pushing for, is have the states use some of that money for mid-mile fiber. Connecting up some of these last mile fiber bids. There's also going to be a lot of fallout. I mean, just last week, Ariel Roth, who's head of the NTIA, said we want a commitment from any BEAD recipient that you're not going to need any more federal government or state government OPEX or CAPEX. Well, wait a minute. I mean, these are rural areas that are mostly going to need OPEX. So I think there's going to be some fallout. And what we've seen is there's a 40% on average match. So if you're getting a $20 billion grant, to serve a particular geography, okay, you need to be responsible for 8 million of that. So there's a big finance opportunity. There's a big JV opportunity. The biggest thing I see, and we saw this a generation ago under the Obama BTOP program, and we saw it with the RDOF program, they're going to be what we call in our group a lot of dogs that caught the bus. A lot of people that were lured in by free money. Wait a minute, I can't build this in 4 years. Or I had no idea fiber was this expensive. So I think we're going to see dozens and dozens of these properties flipped, traded, consolidated, a lot of activity for our space. The other thing is that this is not just a one-time offering. We're going to see many more of these broadband grant programs. And the Trump administration is all in on this, right? I mean, 84% of the BEAD money is going to red counties. I mean, this is the Trump base. They're not going to discontinue that. So we're going to see probably $14, $15 billion in RDOF 2. We're going to see ACAM. Every year we have $4.5 billion of E-rate. We have every year $700 million of, school and rural library. So, at least for the end of this decade, or probably deep into the next decade, we can probably count on average, $5-6 billion going into broadband funding, both last mile and mid-mile. And we're also seeing more M&A, and we're involved in the Crown Castle Zayo consolidation. I think we're going to see more consolidations, but they're not all winners. We've seen, companies like Fastwire, Everstream, in financial distress. So it is going to be a market with a lot of turbulence, and thankfully for all of us, a lot of opportunity.
Just add to one thing that Andy mentioned regarding government funding. One of the items that I've seen in a prior life, I did some work on the government side under the Obama administration's infrastructure funding, and the amount of companies that were receiving either cheap or free money from the government that did not understand the nuances of what they needed to do in order to keep those funds, obtain those funds in the first instance, and then retain them without there being, recapture effectively from the government was somewhat shocking. So really understanding the details of that before you get, waist deep into it is very helpful. In my experience, the government agencies are very accommodating upfront of like, this is what we need, this is what you need to do, these are the boxes you need to check. But you actually have to check those boxes. And if you're not prepared for that, very quickly, you're effectively in default under your government loan grant, which is, defeats the entire point of you having gone through that process. Your cheap money is now the government's asking for it back. So on the upfront, it's almost a diligence exercise into itself of what does this actually mean for us from a how do we operate our company, how do we operate the assets going forward. And we actually have had a lot of companies that we've worked for both on the private side, receiving government funds, as well as when I worked doing representing the government on just handing the funds back to the government and saying we can't comply, which is obviously not the desired result from either side for these programs. Jason.
Hey, I had a question maybe for Rick and for Kevin. Andy hit on a topic of all the government funding and grants that are out there. From a sponsor perspective, an investor perspective, if there's volatility on what can be expected coming in, coming out, how big a program is going to be. If you're a sponsor and you're looking at a company that is looking to tap into those funds, how should you be thinking about the impact of that capital coming in? How is it accounted for? Like, what things do you need to be thinking of when you're trying to value that company and thinking about, how consistent that capital base is going to be and where it's going to show up, on your income statement, on your financial statements, and how that impacts, your entry point.
That's a very thoughtful question. I think it has a few layers to it. I think the first thing is to determine in any business underwriting what you're actually able to count on. And I think in particular in those markets where need is a factor, or kind of any of these grant programs, the idea of grants in the digital space is not new. It's been around for a very long time, and then in some cases it can make or break the investment thesis. So as you think about BEAD specifically, you need to determine relatively early on where the definitions of the grant align. So I think Andy made a reference to a number of situations where what was a qualified geography no longer qualifies. There's a variety of solutions that have surfaced and evidenced themselves as disqualifying those markets. So you know, a business case is by definition granular. It has to start foundationally from the bottoms up approach. Where are the geographies? What are the markets that are being addressed by the capital opportunity? And what are they dependent on? If the case is that these markets to be built require a certain amount of subsidy to get to I'll call it a net cost of deploying the markets, justify any kind of a return to the investor, well then those need to be, first of all, validated, and if the variables change, you need to change your own. And so it is a constantly evolving and dynamic situation, and for a lot of investors it's been a challenge, and I would say for some it's much distress because they built things that turned out were competing against other things that other factors that they got the best of them. And in the worst cases, they levered up their businesses very heavily in anticipation of everything working out perfectly, not realizing that as they were levering up, there were things taking away the foundation of the investment in the first place. I think this type of investing in the kind of scale that we're talking about across these ecosystems, and in some cases even greenfield builds, are unlike other startups, large right from the start. And I think the pace with which they accelerate from there produce great successes, like a Metronet in the space who started modestly and created a model that was replicable and a way to assess market opportunity that made them highly distinguished. And as a result, a great strategic partner to the likes of T-Mobile to continue to replicate that thesis. Similarly, even smaller regional players like Lumos, for example, started off with a kit that was largely unique to a particular geography, and in the context of their commitments to their joint venture, had to orders of magnitude replicate their capabilities and be able to apply all of these skills. What's the adjacent market where you can compete successfully? What's the reliable sources of capital that are needed for that? What are the spin wheels that need to be put in motion to accelerate that set of activities? And by the way, unlike technology, the idea of digging ditches and hanging wires on poles is not as easily scalable as some other functions. And there's a lot to these underwrites, and it involves a lot of different disciplines, as I said at the earlier part of the discussion. And I would also say that these regulatory wins, while they seem sometimes subtle, a little more beat, a little less beat, when you get down to a particular market, it makes or breaks that opportunity, and oftentimes it's binary. Now, binary can also be binary instead of good on the other side of the equation. For example, there were a lot of wireless broadband players who were doing some interesting point-to-multipoint type of activities that were struggling when BEAD was promising to bring fiber into their markets regardless of their existence. And certainly, in some geographies, they have a new lease on life. And so I would say nothing in the PMT space right now is easily brushed with one brush. I think it's a really important time to take the kind of approach that we're used to taking, which is really deep, granular assessment with all the disciplines that can affect an investment.
Can I just add a few other thoughts? So,
Yes.
from an investor perspective, all of a sudden you
Further
find out-
question. Sorry.
Go ahead. I'm sorry, go ahead.
Yeah, sorry. Yeah. So for the question on the common financing, right? So do you expect like more direct financing from the U.S. government, like the Intel deal, right? Like in the Intel situation, the awards under the CHIPS Act converted into equity, and then further it triggered more private financing, right? So do you think this will be the more kind of new normal for these long-dated projects, right? Because Intel's Foundry, obviously, large-size transaction, multiple years, but as you said, the greenfield data centers are the same, right? And large and long-term, right? So do you see this kind of U.S. government direct financing plus additional private financing, for example, the J.P. Morgan talking about American first financing with the U.S. government, right, to be kind of the new normal to emerge in this market?
take a shot at predicting what the U.S. government's going to do. I think on a national governmental level, there's a bit of a tug of war. But I think while there are grand initiatives that are time to market oriented, so land grant oriented on the world stage, where the government clearly wants to have a complete alignment among institutions. So all the things Andy referred to earlier about fast tracking, enabling, attracting capital to do certain things on an expedited basis. I think we'll see a fair amount of that, almost regardless of administration in the near term. I think in terms of actual government balance sheet exposure, it feels in the near term like it's likely to be much more inducing other parties in nature. So think of the U.S. government as the catalyst to get lots of other capital parties to the table to do something that is a targeted opportunity or something of national interest, like a big chip foundry type of project. Most of the largest of data center opportunities have been anchored around the balance sheets of private companies and or public companies, as the case may be, but what I mean is non-governmental. And I think that has enabled an enormous development cycle in the category. We don't see any sign of let-up in that, barring some technological shock that no one knows about. But I'd say that the U.S. government is not unlike many other governments around the world at the moment that are recognizing the need to have digital infrastructure for the next generation. And if they're going to stay relevant in the next chapter of this digital evolution that began long ago, they're going to need to have, I'll call them sovereign access to these types of assets, and that is driving this type of infrastructure across the globe. And in candor, the biggest drive probably ever in the data center sphere is happening on the promise of what's to come in the world of AI, which nobody fully knows. And as somebody who lived through the .com cycle, I would say that it's likely to come, but not likely to come exactly as you think, or on the timeline that you think. Because I think many of the promises of the 90s turned out to be true, actually in some cases better than expected, in some cases much more dominant than anybody ever dreamed of, but not on any horizon that was perfectly predictable, and that did cause the great pains of the early 2000s. And unlike that time, this time around, these projects are being backed by some of the largest companies on earth, and the promise is theirs because they're putting their neck on the lines, if you will, to meet that promise. We'll see how it plays out.
I would add, I don't think even this administration is directly going to take an equity interest in most digital infrastructure, but I think it will be more subtle. I can see pressure for free access, discounted access to government users. I can see, preferential, treatment to new technologies for government. I can see the federal government, exerting a fairly heavy hand on direction and partnering and other opportunities. That's how I think it will play out. In terms of what issues I think investors should look at, particularly for grant funding, first of all, a lot of investors don't realize that the government gets the first lien. Okay, and a lot of people are put off by that, but that really just means that you're going to commit to build out your network as you proposed. The other thing I think investors should be aware of is if it's a grant, you'll need the government's approval to sell or transfer or put a restriction on the asset. That's almost always granted, but again, there's a time issue involved. Another thing is, what's your private match? As I was saying, would be the match is 40%. But that doesn't necessarily mean you need to pull out your wallet. I mean, you can make in-kind contributions for 40%. And then, you know, for some of the grant programs, what are the restrictions, you know, if you don't build? Okay, so what we've seen after RDOF is after a while, you know, if you're turning back your network that's unbuilt, your penalties ratchet up. So if you decide, for whatever reason, you're not going to build, you know, you want to, you know, act quickly and not sit on it because you're going to have, you know, extra penalties. But again, I think these are maneuverable, and a lot of companies have done very well. Invest, you know, Zale, for example, Windstream, you know, comes to mind, you know, investing in, you know, broadband grant opportunities.
I'd add to, going back to Jason, your question, and in addition to understanding the legal and regulatory ins and outs of it in detail of grant funding, from a financial due diligence point of view, like, it's not new, right? As I said, there's various different grant funding that's been out there for a long time, and with the new additional fee funding, it's going to be significant going forward. But understanding really the way we think about it from a diligence point of view is understanding the key financial and commercial terms and the nature of the cash payments. And some of those cash payments will be more fund OpEx and be reoccurring monthly cash flow payments in nature. Some will be much more lumpy nature, dollar value spent. And the accounting for it, some of that can sometimes end up in EBITDA, but what we like to do and what we see a lot of investors liking to do is understand the different components of your EBITDA. What is the pure fiber kind of end-based user EBITDA? What is it including regulatory grant funding? And because of that, it just really comes down to understanding the cash flow profile and really making that into a valuation that's DCF based and confident when that cash flow is going to be coming into your valuation, rather than a little bit of a gray area that being in EBITDA or not, right? And to Andy's point, from a balance sheet point of view, there's often a lot of commitments and contingencies that won't even be on the balance sheet that you need to know from a legal and regulatory point of view. And keeping that in mind of what commitments are there, and potential off-balance sheet liabilities are there that you're stepping into for grant funding that's been received becomes pretty important. And from a really executing an SPA, getting a deal done point of view, again, this comes back to those dollar values can be huge swings in cash flow between diligence, closing, post-closing, and for both buyers and sellers to be aware of that early on, that's going to be a big swing, having alignment on how's that going to be treated. And then we've seen it historically of that, in addition to CapEx, creating unique purchase price adjustment mechanisms in SPA to just get alignment on that, have fair treatment, and efficiently get the deal done. And I think with the uncertainty around the BEAD funding program and everything you just labeled, and more of that coming to market, and those winners and grantees potentially being major targets going forward, it's going to be super exciting to see how value is attributed to that and how deals are done when there's uncertainty in that funding at times.
Related to BEAD and fiber to the home, there's just a lot of fragmentation in the market already. I think the numbers we have is something like 1,300 providers that are 25,000 or fewer passings in the U.S. right now. There's a lot of consolidation. This guy's going to be busy here for a while. That's about to happen. And obviously, as Andy, you mentioned earlier, there's no two fiber to the home providers that are created equal. I mean, really, you have to look at how is that team then performing, execution. Obviously, the MNO has begun to consolidate the market. So we're beginning to see what the playbook looks like from a consolidation standpoint in terms of what's driving ultimate value. But if you think about those 1,300 providers, to eventually get on the radar of the big consolidators, they need to all kind of group up and create mergers and create acquisitions and buyouts. And BEAD is only going to exacerbate the amount of fragmentation in the market and opportunity. And from an investor perspective, the ability to evaluate the asset you're looking at is really critical. You look at it with a lot of precision. Thankfully, there's a lot of really good tools coming out. Some AI enabled, some just technology enabled that really can look at on a real-time basis. Like what were the new activations made yesterday on a fiber home network, and what is the relative market shares in a market between the different providers. I mean, there's a lot more information at our fingertips now to evaluate successes, and even prior to getting access into a business, there's a lot of outside in that can be done from a commercial diligence perspective on fiber. It's really one of the things in the space that lends itself really well to a lot of critical analysis from a commercial standpoint.
Ed, you earlier mentioned assets that are out of favor. I'm curious what the panel thinks about why there isn't more interest in perhaps cable assets, copper assets. You look at Archtop in New York State, having purchased 3 old telephone companies and upgrading them. Why isn't that happening elsewhere, for example?
I would say it is. I think there are plenty of examples across the country of folks that were more traditional telephony folks that have become aggressive fiber to the home players, and some benefiting from all the grant programs that we've referenced, and others just commercially buttressing their market position, as you might expect. They're not lying down. I would say cable has been by far the most successful over the last decade or so in really leveraging their plant access and in some cases superior network capabilities to garner not only consumer broadband initiatives successfully, but also on the commercial side making tremendous strides over the last decade or so. What's happened is, in large measure, they were too successful, and many of the I'll call them overbuilder types or even reformed telcos are simply taking back part of the market. And so as a result, when you look across the cable ecosystem today, they trade on the back of the reality that they may be likely ceding market share for a period of time. It is a fascinating time, though, to think about the size of the cable industry, the size of the telephony space, and the, I'll call it macro conversion that is happening between wireless, wireline, in some cases satellite augmentation, and also the overlay of 1,300 or more, perhaps, when you bring into the equation all the wireless players that are playing on an unlicensed basis, folks that are doing application-specific deployments, and I think it gets dizzying when you further layer over it the folks that actually make the access medium disappear and are accessing a customer for a particular application use, and increasingly as time goes on, there'll be super apps and other tools that are intended to make you never think about the plumbing in the network, but rather think about a brand as your application to grab market opportunity. Along this path, a lot of things will happen. I mean, there are an enormous number of players today in the marketplace that are trying to figure out how to line up for the wireless convergence play that Ed referenced, and we're in the position to help people navigate those waters, having done most of, in fact, I think all of the transactions that have played in that sphere. There are folks that are looking towards their businesses and saying, hey, I never want to sell to one of those companies. I want to make sure this network is a generational asset, and therefore, what do I need to do to be successful in perpetuity? What is a minimum scale, which might drive consolidation thinking? What is the minimum investment required to make sure that the technology can face off with any competitor from anywhere? What are the attachment points to a customer that are immutable to defend against churn characteristics? These are all real-time things specific to the fiber space that are happening as we speak. And by the way, nobody's standing still. So while cable is maybe at a macro level disadvantaged for a period of time, they're also densifying their networks. Fiber is moving deeper into their networks every day. They're rolling out the next generation of DOCSIS, which is intended to give them bandwidth compatibility or the ability to go to market for what still is a majority of the marketplace that doesn't care if it's a one fiber type or some other bandwidth medium, as long as they can get a reliable service offering that's, quote, good enough at the right price. I think that varies dramatically by market. I mean, there are geographies like New York City where you have almost a complete elasticity to price to embrace the right broadband solution. And then there are other markets around the country where the alternative to a broadband solution is beer. And they're making judgments about whether they're going to have beer this month or pay for internet. And those are very different competitive backdrops. And as one might imagine, the technology and the competitive dynamic are vastly different in comparison.
Dave, I think you're right. I think that rural local exchange carriers and rural cable companies' values are unfairly, unreasonably discounted. I mean, first of all, these are going to be the big winners in BEAD, okay? These are the companies that have DSL, copper, old cable that are less than 120 megabits down up that can get federal funding to overbuild themselves, both, offensively and defensively. Secondly, a lot of these companies, were just taboo historically for investors. I mean, I've seen this. I think we've all seen this. Oh boy, I don't want to get involved in all these USF, revenue streams. But investors, particularly foreign investors, have figured that out. I mean, a lot of the, Cincinnati Bell clientele owned by, foreign infrastructure funds. Their, Empire here in New York is owned by Hampton. I mean, they're comfortable with that now. And, these are great companies, okay? I mean, they're, rural, they're hard to understand, they're quirky, some of them are co-ops, so you got to work through that funky ownership structure. But I think you're going to see a lot of M&A activity in that area. There are 900 members of the National Telephone Cooperative Association. There are probably 600 members of ACA Cable. I would bet in a decade, 2/3 of those companies, if not more, are involved in the M&A opportunity.
I just, Dave, address your question to me, so let me respond. Out of favor being a relative term. I think when you're seeing, cloud data center and AI data center deals getting done at 30 times plus EBITDA, and you see things trading that never will be replicated again, trading at a much lower value. I think Rich is right, Andy's right, that over time, I think you'll see a lot of those assets that are really irreplaceable trend up. And, I think of there being, some analogies in the market. It's probably not a perfect one at all, but I think of, the long haul networks getting all of the excitement back around the turn of the century, but really the winners were the metro networks, right? The ones that were harder to build down the downtown streets, the Zaos of the world, the MFSs, as being the ones that ultimately really capitalized for investors. And, I think ultimately there's going to be winners and losers everywhere, but a lot of those things that are difficult to replicate right now, I think by a lot of investors are largely being ignored. And ultimately that's where, out of favor comes in. And I think ultimately where a lot of opportunities may exist in the future.
Maybe one last thought on this fiber sphere. I wanted to piggyback on Andy's comment about how many of these companies may not be here in a few years. It's a marvel to me when I look back on the times since the early 90s where we had almost an identical dynamic and all these companies nobody ever heard of in all parts of nooks and crannies in the country, and many of them were consolidated, but many, many more were created. And so the dynamic and the cycle in the space will likely continue that way. What folks are doing in that trajectory that I described earlier likely will maybe change what they do. So not everybody will be focused on the ditches and the shovels and picks to do the work that they do today, but it may be how people employ capabilities that becomes the new innovator and how people play in various geographies. But I think the excitement will certainly be there, and I think consolidation is a big part of playing into some of these teams, but in some cases also deconsolidation becomes a big part of how you play because there are some very large companies that are in need of maybe creating new environments for success with their businesses as well. And we're excited to be part of that. We're targeting some of the largest companies in the country that are playing in this ecosystem about sizable carve-outs of parts of their companies that would be much healthier and better off as part of independent opportunity set, and in some cases that might also accelerate the appreciation of some of these companies that are not held in the most favorable light in terms of achieving their more optimized value proposition.
Had a question, just because you had mentioned about the favorable political environment as relates to the digital arms race, in the next midterms. Is there anything in particular that's susceptible to becoming more adverse to this favorable environment that we have on a tax basis, incentive basis? Thank you.
I don't think so. I mean, I personally think that the Democrats will take one or maybe both houses, but, all that will likely mean is, FCC Chairman Carr coming out from more criticism, which, is like water off a duck's back. I mean, Congress, has had a very difficult time legislating in this area since the '96 Act, so I think the best they'll be is kibitzers. Maybe at the margins they can, reduce some of the extremes of this administration. But, when it comes to infrastructure, it's largely bipartisan. And it largely is becoming, a two-person race between the U.S. and China. And, views on U.S.-China national security, thankfully, are still one of the few things in Washington that's still bipartisan. So, things could change for sure, in 2028, 2029 if there's a new administration, but I don't think the midterms are going to have, a material headwind.
Yeah, I think I agree with that as well. I think the one thing that is sort of interesting as we kind of go through this evolution of, movement from telephone to internet, essentially, is really thinking about like what is that tax base. Like historically, BEAD funding has been primarily funded through telecom taxes, and so like as the use of telephones becomes less, the revenue from a funding perspective also becomes less. And so I think that we really need to consider a maybe more provocative question of like, what will that be? What does that look like? And the Congress generally lags behind technology in a pretty meaningful way, but really they're going to have to figure out that funding gap and like what does that look like and where does that come from? And does that come from fiber? Does that come from data centers? Like where do the interconnectivity points that potentially could create revenue is the government going to look towards?
Are you in all of your advisory capacities? Are you seeing? We talked about this at the last meeting. 43 billion underserved and unserved community that is on the ACP going away, right? But then I see here you talk about consolidation and deconsolidation, and we see a company like Stargate acquired for it's playing in the fixed wireless space. And is that a trend that you're going to begin to see more in order to kind of address some of these issues for affordability? Because that's something I think Andy and I discussed in the past, and I think we need to be, from my perspective, we're focused on how do we reach those kind of folks, and how do we provide them with the affordability. And are the larger companies beginning to look at this from a different lens now? Because I've never heard of an acquisition of a fixed wireless company just to leave the market, but I think it's something that's beginning to take place.
Well, I personally thought it was a big mistake to get rid of the $14 billion ACP program for low-income providers. Some of the states, like New York State, have their own program. Some of the providers, particularly Comcast, Verizon, are reaching out, and it's to everybody's benefit. Okay, this has been true since Alexander Graham Bell, the externalities of the telecom broadband industry are such that you want to get 100% ubiquity. I mean, that, enhances the value for everybody. So I think it's going to happen. I mean, it's going to happen, a lot less fluid than if you did have ACP. But I mean, those are very strong markets. I did a lot of work for RCN. Our most valuable markets were low, income markets, because that's how people mostly got their entertainment. I mean, they didn't go to the Garden to see the Knicks game. They watched it on TV. So, people who can monetize that market, I think, have some really great opportunities.
I echo much of that. I think the other side of it about wireless broadband companies being consolidated, et cetera, there have been. I think there have been a number of regional consolidations in that ecosystem, and I think the question mark of where does wireless broadband have advantage over any wired solution was heavily tied to sources of regulatory dollars. So in places where somebody was willing to provide, the government was willing to provide monies to fiberize a community that otherwise is uneconomic to fiber, then the wireless opportunity is damaged. In the case where some of those wireless companies have been able to demonstrate that they can provide the required broadband proposition on a measured basis, then they have been successful in carving out their market opportunity from the availability of BEAD, which in large measure means there won't be any fiber solution in that market because of the proper bandwidth opportunity is being satisfied by a wireless solution. Technology is in play here. The regulatory aspects are also at the whim of the taxpayer community. There are stories that you can read that were published in the various medias about some house in Alaska that doesn't have another house within 5 to 10 miles of it, and it cost $180,000 to get to that house to fiber it for some reason, and it was being funded by tax dollars to make it fibered, and nobody lit the fiber there, but it's passing that home, and it doesn't seem like anybody's going to live there anytime soon. So there are some extremes in these debates that folks will undoubtedly want to have some tug of wars, but I go back to what Andy said. I don't think there's any macro grand stroke pull away from these commitments at the national level and what form they will take. And, there are so many varieties of niche grant activities from, Andy and I worked on something in the, I'll call it for the deaf community. There's a program that enables subsidies for that ecosystem uniquely. And so, look, at the national level, we are providing means and opportunity for the country to participate in this digital opportunity set in so many varieties of ways, and those ways may change, but the net direction is unlikely to change. I think we're committed as a nation because the population and the electorate is committed to participating in a grand way in the next chapter of the digital opportunity.
I think it might have been a bit ambitious to try to go deep on fiber, broadband, data centers, tower, and wireless. This will probably cut into the Q&A, but it's great. We've got open Q&A going on, so I think if people are okay with that, maybe keep the conversation going. And top of favor in the headlines, obviously, in the investment space is data centers, so it would be a shame not to get to that. Mike, I know you've been close to this on data center deals, but also in the power and utility space. Do you want to share your thoughts on what's keeping you busy and what exciting stuff you've been working on?
Yeah, so I think everyone sees it. Data centers are really exciting. I'm the co-head of our firm's data center initiative, overseeing all aspects of the sector. And what I think is really we're seeing is just the scale and the build out of this. It's not only the number of them, but the size and scope. So you've got something where it's one thing to be constructing something that's a $50 million, storing Morgan Lewis's, off-site information as a data center. But the hyperscalers of billions of dollars of an infrastructure asset that's being constructed, and all of the inputs and outputs of that, it's layers of complexity that are, creating, I think, just, from my perspective, from the legal perspective, it's excitement in the market. But I think, everyone else is racing to, put a shovel in the ground and to really do the build out of these. And I think the bigger thing is to stop and look at other sectors and how do we do this? And also, what are you going to do with your data center, in 2 years, when you're 5 years, whatever that is. And so the way in which, from our perspective, we think about it is not only looking at siting, finding the optimal site for the data center, thinking about whether there's obviously power, but also redundancy of power, other utilities, gas, water, as well as obviously fiber coming to and from. And one of the focal points for the hyperscalers is in all of these areas for there to be redundancies to ensure that they've got nonstop supply of the data center that's going to be operating 24/7. And that's something that's unique when thinking about it from a typical power project where there's planned outages, there's it's part of the process that they're going to be on and off cycling through their annual life cycle. But when thinking about it from the data center side, you're focusing not only then on how are we building this out, where are we building it, but where are those redundancies, and then step two is how do we finance this. And from a project financing perspective, you want to ensure that all the bundle of sticks are all there. You've got, as I said, you've got all of the utilities, siting, the real estate rights, as well as the long-term lease that's going to actually ensure a contract right that from a project finance perspective, you can actually get this financed at the level of dollars that you need. And then you've got a creditworthy entity, you've got an AWS, Oracle, Google on the other side that's actually backstopping that. And then similarly, that you've got the long-term power supply, and redundancies in place such that when the lenders are looking at it, they're looking at the same things that AWS and Google are looking at. That you've got all of those things built in such that this is not a 3-year asset, it's a 20-year asset, 30-year asset. And the lenders, from their perspective, again, this is a $50 million loan that we're financing and we're looking at a debt equity ratio on it, like we can make sense of that, but when we're talking $2 billion, where just the multiples of scale, the amount of banks involved, the amount of diligence that's involved in that process is just multiples of what you're looking at. From my perspective, the analogous projects that we've worked on in construction, development construction of would be a conventional power project just because of similar locational assets or interests, not in my backyard, obstacles you have to fight, permitting, regulatory approvals, and just the size and scope of it, the dollar amounts, the ways in which the financial industries are looking at how they can scope those. I think there's, as I mentioned before, there's been a lot of positive developments. If we could have behind the meter power for data centers, that would be a huge improvement. But when I talk about redundancies, you still are going to have to likely be interconnected to the grid, at which point you've got a utility that you're still having to appease in order to be taking load off of their grid. And if you've just taken a power plant or power assets off of their grid right next door, they're not inclined to really be supportive of you connecting to their grid. So while FERC and PJM and the other RTOs may be supportive of behind the meter co-located power, there might be other unintended consequences of doing that you've got to think through before you actually are thinking you're going to just take a 800 megawatt generator off the grid as being your primary source of power, because of the fact that generator is going to need to go offline during the year, and so you're going to need to be interconnected in order to get the backup power supply. But I think it's an exciting time. I think that where we are today, I think everything is going full steam ahead. And another thing that we've even seen over the last year is every time that there's a new news cycle, DeepSeek, I think of back in the winter, where you hear these things about, well, what about if there's increases of efficiency? And what does that mean for the build-out that we're currently doing of these data centers? Are these going to be obsolete in 18 months? Or is this really a 20, 30-year asset? And I think kind of looking back at other cycles of industries, there's some element of that you've got to just still charge forward with what we have and be aware of the fact that there's going to be obstacles and speed bumps, and there's going to be items that items that you need to overcome. When the DeepSeek news came out, I was working on a power asset for a data center in Virginia, and I thought, well, this is going to be a bad day for long-term PPA, because there's someone out there that can make chips that are going to be a fraction of the power requirement of what we're doing. Then this PPA is upside down in no time. The response from the hyperscalers was, we'll just build more. It's not a land issue. It's there's other issues here, but if we actually can increase the efficiency, we'll just put more racks, co-located there in order to use the power that we need, and that's how we'll deal with the positive development of technology. Anyway, I think it's exciting. I think there's a lot of variables, a lot of risk, and I think there's a lot of things that are coming to a head today in the data center sector that I think are, from a legal perspective, as I said, I find very interesting. I think from an investor perspective, I think there's, maybe an opportunity to tap the brakes a little bit, but also to be excited about the opportunities.
I'll just add a few things. The data center sector is not a homogeneous sector. I mean, there is a very different set of risk and reward opportunity in each of the subsectors. So the hyperscaler sphere, in some measure, is largely less risky because you're not really taking much commercial risk if you have the right contracts, the right arrangements. So the challenge to the hyperscale part of the marketplace is getting it right. And so these transactions tend to involve enormous numbers of people. We were just involved in one of the largest in the country, where it brings together two of the largest investors across data center and the energy space, two operating companies, one big power company, the other one of the largest data center players. And you might imagine 5 of the Magnificent 5 are the offtake parties. And in these transactions, the key is to make sure you have the right relationships in place to ensure an uninterrupted execution. The technology and I'll call it efficiency drivers, etc., are the risk of the operator who's leveraging these infrastructure elements, and they're making the long bet. And that long bet is limited to their lease horizon. So at the end of that lease horizon, if the world has changed, the efficiency curve has moved, the availability of alternative facilities, technologies, whatever have you, affords them a free option to move to the next thing. In the segments of the marketplace that relate to interconnectivity, so the folks that own some of the facilities Andy referenced when we started this panel, the dependency on those interconnected venues has never been greater, and there are fewer and fewer of them that are independent companies. They've all been consolidated into much larger platforms in the ecosystem. And so folks that want to go from a hyperscale environment to any cloud environment or inter-cloud environment, and over time create greater meshing of all of these solutions, will be increasingly dependent on these, I'll call it high inertia interconnectivity environments. And so those spheres have only grown in strategic value by virtue of everything that's happened around it. And I'll stop at the commercial and enterprise part of the marketplace. So in the new world order of AI and every variety of cloud activity, outsourcing proposition, et cetera, the enterprise marketplace is still migrating out of that closet I referenced earlier. I mean, there's still a lot of companies that still have their own infrastructure. They still have a high dependency on their own direct capabilities and have never been able to trust, let's call it shared public, in some cases, not clear whether they're even in their sovereign geographies where their data ultimately is going and not coming from. So there is a huge and still nascent, I think, commercial and enterprise activity that is getting tougher to navigate in the AI world, where you don't know if your private information is properly captured and ring-fenced, living in your own environment, within your own sovereign regulatory and legal requirements, let alone beyond that, but network security and information security you have. So there is a huge and growing opportunity set in that sphere. Some people broadly refer to it as the inference layer. I think it's actually much bigger than that, because there's a hybrid IT component to that that is both infrastructure, software, and application touching, that is I think the highest inertia category, where enterprises will become extremely dependent on these types of service providers to enable them to compete in the next world order against folks that are able to employ those kinds of technologies. And to do that, we have another opportunity set in that sphere that is pretty dramatic and still evolving and developing itself. I mention all of that because you can imagine the risk reward from an investor's perspective is dramatically different in the what I'll call project finance end of the spectrum versus real service provider, broad, diverse, many thousands of customers versus 5. There's a very different, I'll call it transaction deal team that's necessary for that ecosystem than is for the other. That's not to say that one is more or less sophisticated. There's tremendous sophistication at all ends of the spectrum, but it puts a big premium on assembling the kinds of people that are necessary to execute successfully and knowingly. I mean, a big part of successful underwriting is doing it with your eyes open, not finding yourself in a situation where variables that were knowable suddenly appear and really disenfranchise the investment early on.
Thanks again for hosting this masterclass. So I was curious just about the power aspect of it, because it seems like there's growing from a regional perspective. West Texas seems to be the hot spot for a lot of the data center in terms of power, but then you're hearing a lot more pushback about the rise in cost that, from an energy perspective on a public standpoint. Is there, resistance, from certain regions about, these data center builds and like the impact that it might have on the surrounding communities in terms of inflation? Thank you.
I'd say there's like a lot of NIMBYism going on, and so especially with the rise of data centers, and I think in some ways kind of states that are looking at incentives and credits associated with that are really trying to assess out a bit more around, beyond just the typical parameters of the build, like what jobs are they actually creating? Like what are data centers bringing to the table in order to achieve those incentives and credits? And so trying to figure out ways to manage that aspect of it certainly is a lot of what we're seeing.
I want to make sure we hear the full spectrum. So there's definitely NIMBY noise, I'll call it, across some of these places where people are evaluating opportunities. But there's also the other side of the spectrum, which is there are states that are making it extraordinarily attractive, Texas being one of them, to bring these opportunity sets to their backyard, because they are rich in resources for power, and they have, in some cases, fallow capacity, and the ability to enable it quickly and seize those opportunities have afforded, for many of the geographies where these things are, some of the most attractive development opportunities in their histories. And fast forward maybe to the largest of the data center markets we have in the country, that wasn't so not that long ago, is Northern Virginia. And I was with an executive at Verizon the other day, and he shared that he lives in Northern Virginia and will not leave for another job opportunity elsewhere. And I'm struck by that because this person is highly marketable across any geography. And he said no, because Northern Virginia has 95% of its taxes paid by the data center companies. And we have some of the best schools in the country. We have some of the finest infrastructure possible. And it's created highly intellectual communities that I would never want to give up again for myself or my children. That's a perspective. So I think we're still figuring this out. I think there are rural communities, for example, that are getting a lot of these big LLM style projects, and it's going to be a shock to the system. There's going to be suddenly in some of these backyards, $5, $10, $15 billion projects coming to their communities. Nothing like that has ever happened in some of these states, ever, in any formula or framework. Now, some undeniably will say, you changed the environment. Well, that's perhaps true. And these projects are approved by elected officials who will have to be accountable to their electorates about what they did. I suspect, though, in those places where these projects get built, those same elected officials are going to be piggybacking on those projects and trying to capture those people with additional projects. And I guess one market that strikes me is Cedar Rapids, Iowa, that probably most people have never visited. QTS announced a big facility there. Not too long thereafter, the governor of the state announced all kinds of additional investments that they're going to make to complement that activity, including housing, entertainment, all kinds of varieties of things to try and capture and keep those talented engineers and so forth that are coming into the market specifically for one project. Shortly thereafter, Google announced that they're going to piggyback too, and said, hey, if you're creating the ecosystem that makes our risk-reward exposure that much more interesting. With the demand sets of all these power demands, suddenly there's also a new nuclear power plant project that is coming to the marketplace. So suddenly, Cedar Rapids, Iowa went from, let's call it a multi-billion-dollar investment to now many tens of billions of dollars of investment. And some people in that marketplace will undeniably complain about it because it is going to change that environment dramatically. But also some of the people in that marketplace are going to be sitting in their regular day lives saying, I went from being part of a relatively rural community to a really wealthy, vibrant, dynamic, very changed environment in a relatively short order. And for some, that's going to be a fantastic move. For others, may not be the thing they really wanted, and they'll probably find someplace else to live. But these are undeniably going to be displacing activities, and whether it's good or bad will be a highly subjective thing.
I think we could go for a couple more hours here, but I think we should cut it off. We're 10 minutes over. Look, on behalf of Leo Berwick, myself, the other sponsors, the panelists, huge thank you to you all here in person, everybody online. I found that super interesting. I think hopefully that was super insightful for the folks here. If there's questions or topics we didn't get to, I think got a lineup of geeks that love the space and are totally keen to discuss that with us right now, or if you want to reach out. And we all love working on complicated, interesting deals in the space, and we're all open for business. So please keep us in mind and reach out. Huge thanks to Morgan Lewis for hosting us here. Not only are they a top law firm, I hear they have the best coffee of any law firm in the world. And fortunately, we budgeted time for coffee and networking, and folks still have time to hang around and hang out. So with that, thank you all again, and we'll